How many of you have contributed to a GoFundMe by a show of virtual hands? Raise your hand up if you've contributed something or donated something to a GoFundMe. Yes? All right. Good. Any of you have ever had any friends pass away, any family members pass away, and they've raised funds for that at all? Have you seen that kind of contribution?
Yes.
Mm-hmm.
And GoFundMe is a wonderful platform, right? It's a fabulous platform for all kinds of stuff that you believe in. However, GoFundMe isn't a replacement for life insurance, for planning it out. A lot of times it's very affordable. The thing is, sometimes it's more of educational. We didn't grow up with it, or you weren't exposed to it, and I don't need it. But there are some wonderful options for you to do that. So we're going to break through some options today to kind of give you perspective and make it easy. So what exactly is life insurance, right? It's a contract. You promise to pay the insurance company the premiums, and they promise to pay your beneficiary unless you have some kind of mystical power where you still stick around beyond death. So they take care of your beneficiary. So you're planning for, if you married, your spouse. If you're not married, your children, people in your lives, your family members. You're thinking about them as when you're doing these plans. So that's the basis of life insurance. The contract, you pay them, and they promise to reimburse you and make the whole family whole. There are more different types, but we're going to cover the three basic types to put in perspective, right? Term, a whole, universal. Are you guys pretty familiar with these terms? You've heard them used, or you may even have them on your own?
Mm-hmm.
All right, term. What do they mean by term, right? It's a set period of time. Usually you hear like there's a 10-year policy or a 20-year term or a 30-year term. A set period of time. So the term is how long is it going to be in effect for? Thing about the term policy is there is no cash value. You pay your policy for 10 years. After 10 years, it typically will end because you can't afford. So you might be paying, say, $25 for the 10 years. When it gets down to the 11th year, that $10 becomes $100 or $200. So that $100 becomes $1,000. So while it may continue, the thing is most people cannot afford it beyond that term period, beyond that 10, 20, 30, whatever you set it for. And there is no cash value. It doesn't build up. So what you're paying, the $10 a month for 10 years, after that, it's finished. Well, the attractive thing about term policy is that it's very inexpensive, which is why a lot of people get them. And what you typically don't know, or when you get a mortgage or a property, they want to sell you mortgage protection insurance. And that, again, is typically is term insurance. So what's a typical span of a mortgage nowadays? How many years would you guys guess is that? Typical
30.
mortgage? 30. Which is where your term 30, your mortgage protection for 30 years. So it's like, okay, well, how much is your mortgage? If you're going to buy a place right now, if you're going to buy your dream home, what would it be, Kate? What's the amount you would pick?
The amount of
the loan,
insurance?
the mortgage. If you're going to get a mortgage right now, how much is it going to be? What are you looking at?
Well, most houses are probably at least 300 plus.
300 plus. And that's exactly it. When you think about these mortgage protection plans, these typically term policies, people are saying, hey, what happens if you have a spouse? What happens if something were to happen to me with this mortgage? How are they going to be able to financially continue to pay that, right? And a lot of time with these dual income households, it's usually your dual income that helps satisfy the mortgage. So that's where the term policy would come in play and help that. How many of you have group life insurance at work? So the group life insurance is what most people have at work. And why it's so attractive is the cost. Usually you see it's pennies, and then people will opt up to increase it. But then over 50,000, typically there's a portion of that you have to contribute for, otherwise it becomes taxable as well. So that's why people really want to do it, because group life is really inexpensive. And that's just pretty much a nutshell for what the term policy is like. Now we'll move into whole life. It stays with you your whole life, fully guaranteed product. What's nice about a whole product is there's cash value. And there is an interest-bearing and like investment component to it as well too. So as you pay into a whole life, over time, it's building cash, right? You're paying for 20, 30 years of building cash about that, which is very nice. So as you get into your later years in life, you have some options that you can do with that cash. You can borrow typically up to 80% of the cash value in that as well. Versus the term, was there cash value in the term? See if you guys are paying attention. Was there any cash value? Nope. No, not at all. None at all. So that's the beautiful thing about the whole. With the whole life as well, you also have a wider issue that you can for the age range. Term beyond 65, 70, they don't want to touch that. They won't issue it. But with the whole policy, even as young as 84, 85, they will issue a policy. I mean, granted, you're going to pay for that, right? Because of life expectancy, you will pay for that, but you have some options there. Typical examples of your whole life, you have, okay, 10 pay, which is really good for young kids, right? When you're young, how's your health when you're young?
Usually excellent.
Yeah, excellent, right? So then you can get a 10 pay policy for a child, right? That'll build cash value. They'll have this policy so that later on in life, when they're 20, 25, they already have something in place. What happens at 20, 25, your kid starts developing conditions, right? Do you think it's going to be a little more difficult to obtain insurance?
Usually.
Do you think it's going to be the same price as it would have been if you were 10 or 5? No. Which is why a lot of the more affluent families or families who have been conditioned to invest in this, as soon as a child is born, 15 days, they're buying these whole life policies for them. Because then automatically they can transfer the ownership beyond the 10 years. You can take $100,000, 100,000 policy for a child and pay $50, $60, $70 a month. In 10 years, you're done paying for that. Now that child, when they move on and get out your house, hopefully they move out at a relative decent age, unless you're, depending on what family you're from, they'll be 35 and still living at home. But either way, no, it depends on the culture. But either way, the point is they'll have it and they won't have to fuss with that anymore, which is a very good blessing there. And there's pay to 65, pay to 100. How long do you want to keep paying for a policy? That kind of puts in perspective, right? When we do policies at our office, we like to ask people like, okay, after 65, do you really want to continue making those kinds of bills or paying that monthly? That kind of puts it in perspective for you. So we like to do the pay to 65, but again, it becomes a budgetary issue. How much do you want to pay? How long do you want to pay for it? So those are some of your options for your whole life. Now we get to the universal life, right? We had the term life, right, before. Was there cash value in the term life?
Nope.
No cash value, right? And the whole life, was there cash value there?
Yes.
Yes. So universal life is like taking the best of both worlds, right? You have the lower cost structure of the term policy, but then you have the cash accumulating component of the whole life policy and the interest. So that's the beautiful thing about the universal life. It has its play. You got to look at how much coverage do I need? What am I looking to do this? Why am I getting this policy? Am I thinking of perhaps just final expenses? Just, I don't want to leave that with my significant other, my family, what have you. What am I looking to do that for? So the cash value is a good component. Again, you can borrow against this. If you guys are listening, what percentage of the cash value can you typically borrow against? 80. Good. So if you had, say, $10,000 worth of cash value, right? You can borrow up to, you guys did all that math, right? $8,000, right? 80% of that. You can borrow against that. You can do withdrawal later on in life or borrow it. And when you borrow against it, you're essentially borrowing against that pool of money. So you're never lowering the value of your policy because it's just like a collective pool of the life policies that exist, right? So when you're borrowing, you're paying back into it at that whatever 6-7% interest rate. You essentially borrowing from yourself and allowing your money to continue growing, which is a really cool aspect of it. And then there are variable interest rates and guaranteed. Like some of the ones we offer at the office are like 4%, and it keeps growing. And while you borrow against it, the money's growing. So universal is a good option. Depends on what you're looking for, how much you need, and the value. Whole term. What are my needs? Either way, any policy, any of these policies, either way, will put you one step closer or in a better position if you have nothing at all, right? So you have to assess, what are my needs? What am I looking to cover? And ultimately, no matter how good any of this sounds, you don't want to buy into or have anything that's more than you can afford. This is a long-term planning process. Even though, yeah, $400,000 sounds really good right now, but can you afford to pay the $400,000? You're better off getting $100,000 and paying that consistently and knowing that you have that kind of value. Because I don't know about you guys, but is $100,000 a good amount of money?
It's good, but might not be enough for what you need when you need it.
Correct. I can sell you a 400,000. But what if you stop paying it a year from now?
It's useless.
Correct. So is the 100,000 that you can comfortably pay better than the 400 that you can't pay?
Yes.
Absolutely. So it's more of a thought process to get to that. Hey, don't buy more than you can afford, no matter how good it sounds, what you might need. So you got to be honest with yourself with what you can afford. Common riders, and essentially the riders are they're amendments to policies. They sit on top of it. So it makes adjustments or it changes things that you can add. If you add a guaranteed insurability option, right now I buy a $50,000 policy, right? I'll add a GIO, guaranteed insurability option, to buy 50 more thousand. And at that time, guess what? I don't have to go and do another blood draw. Come and check my breathing. And maybe some of you who like to smoke hookah, maybe at the time that you got the policy, you weren't smoking hookah as much. And now all of a sudden you like to puff, you keep puffing, and you're in a different state. By the way, if you smoke, you're gonna pay extra. The policies always cost more than that end of it. So those are good options to buy, and they're usually for $1 or $2 a month. You're paying for that GIO option. Waiver of premium benefit. When you're younger, especially, more than likely it'll be a car accident that'll get you, that'll hurt you, you'll become disabled. But if you have the waiver of premium benefit, it'll cover those premium benefits up until typically 65, age disability. So if you're 40 years old, you're doing a particular job, and all of a sudden you get hurt on the job, if you have this waiver of premium benefit rider attached to your policy, then your payments will be paid until you're 65. And at that point, you're 65, when we're around that 65 age, what do you typically have at that point in your life? Or what phase?
Social Security, retirement.
Exactly. So you have other means, so you should more than likely have other means to continue paying this and help put it in perspective for you. So in a worst case scenario where you have something happens to you, right? You're diagnosed with a condition. Most of these policies, a lot of life policies, have the accelerated death benefit rider, wherein they'll give you a lump sum of money. If you're a doctor, that you've been determined that more than likely you won't go past another 24 months, so that you'll be able to cash in that fund to use for your care, some of your life expenses. And finally, the children's term rider, which is a really cool component of it. So if you have a universal life product, right, or a term product, mostly universal life, and you want to get 100,000 for yourself, and you're not quite ready to go and get the 10-year or 20-pay whatever policy separately for your child or children, you can add this rider to your own policy, which will afford you what they call units or thousands of dollars. So you can get up to 10,000, say, in this particular ones that we have, 10,000 per child. So if you have 5 kids, each of them would be covered for that 10,000. And you can choose from that 1 to 10 in our product. There's a lot of varying amounts, but typically it's that 10,000. It's a nice little addition to your policy, because Lord knows you don't know. We've had some clients who've had their children pass away. Key components: the child must be between 15 days and 17 years old, because with infancy and sometimes a stillbirth or kids, first couple weeks are very crucial for the kids when they're born. So the amounts vary on that end of it, but it's a cool little way to add without being able to, say, get in a separate policy if you cannot afford that on that end of it. How much? This is a question we always get. Well, how much do I really need, right? Yeah, how much can you afford? Say, David, you have a kid, right? You have a kid right now, and for the next 20 years, let's say 20 years. You guys see my little highlighter, 20 years?
Mm-hmm.
So if I want to give this kid a monthly income, right, of $1,515 for 20 years, at the minimum, I should be looking at roughly $250 with the death benefit, because of the power of compounding interest, right? This money will get invested in the death benefit of that. So it would require a $250 death benefit. If I just want to have a mortgage, right? How much is the condo? How much do I owe on that condo? Well, I owe $350, or I bought the condo for $350. Say this is how much I owe on there. If I want that paid off at any point in time, if something were to happen to me, then this kind of puts in perspective. Okay, $350. All right, now that's just the house. What about education expenses, right? Do I want to factor in college? How much is college per year nowadays? It's all over the place. 20, 30. I've seen clients pay 35, 40 grand a year for their kids to go to Penn State, what have you. So not including dorm, not including whatever. It's just tuition. So again, when you're thinking of how much do I want or need, what are you trying to do with it? When our father passed away in 96, there was no life insurance. And there was this mad scramble. Kind of like, well, we wish Gofundme existed back then, because we probably would have been the ones doing the same Gofundme kind of approach. But it was this mad scramble to figure out how you're going to pay. And then when you add the religious component to it, we had that religious kind of thing, burial, the whole process, the wake and all that, and feeding and going through this element of it. And that was a 10 grand expenditure, if not more. I think it was like 11 or 12 grand that the older siblings had to kind of figure out. At that time, we were relatively young. But that's a lot of money to leave for your family to figure out. Because they're already stressing out from the event, right? The life event that's taking place. Now, do you want to leave them with that other element of how we're going to pay for this? So with the simple planning and some of these inexpensive costs, you can do that. And then depending on where you're at, you can do these policies that have cash value to them. And you remember what kind of policies have the cash value? What two types that we highlighted that have cash value?
Universal.
And whole.
Universal and whole. So those have the cash value components to them. So again, if you're planning for your family, let's say you do a 100,000 policy, right? Pay to 65. 65, I don't want to deal with bills anymore. Let's just assume that now I have 20,000 worth of cash value. Now at 65, more likely your kids, if you've had children, at a relatively typical age, you have kids, they're not babies anymore, right? Typically, unless you're a Rolling Stone, like my father was, unless you were a Rolling Stone and you have kids a little later in life. But either way, your kids probably don't have the same need for you anymore. So at that point, if my death benefit was for a $100,000 policy, and now I've taken out, say, 30 grand of all that cash value that I've accumulated, guess how much I have left for a death benefit?
70.
Now 70, would you say 70 could probably cover majority of final expenses, wouldn't you say?
Unless you're going out like a king, yeah.
Right, so you want like a gold lace kind of coffin, whatever you I must have the gold lace coffin. It's a thought of, if I'm going to have this policy, I'm going to plan for things that are unforeseen, put my family in a position where they have less stress. But if I can manage that to survive and I stay healthy and then everything aligns for me, and if I have these whole lifetime policies or universal, depending on how you structure it, I can use some of that funds, right? If I have enough of a cash value policy, I want to pay for college, guess what I can do? Grab the money from that as well and pay for college. I know a lot of people have done that for their grandkids. Like the grandparents will have enough cash value and they would loan the money to their children to buy the car for education, for whatever. You want to start a business, Kate? How much you need? 10 grand? We'll finance it for you. We'll give you a low interest rate. Then you pay them back into the family fund of sorts, right? And those funds are usually funded by when, say, the grandparent or the elder passes away, they have that money go into a family trust. So that money just keeps going forward and they're investing and taking money from that. David wants to start a new business, want to revamp and buy a bunch of gear. David, I need to see your business plan. And you're taking money from that family fund. And so that just keeps that money circle going. The Rockefellers, that's how they've done it. I got a good friend, Ed Lee. He's really good at that. He speaks to that all the time. He does these wealth classes. And they speak to that. And they were all based on these whole life policy principles and having that cash value to really move forward. But again, term is wonderful. If you got a mortgage, right? When you have young kids, the value of a term policy, because of the cost structure, is a no-brainer. For $500,000, you pay 60, 70, 80 bucks or $100 for 500 grand. There's good value there. Sure, at the end, you're done paying for it, and there's nothing there to show for it in terms of, okay, but what if in year one, for a $500,000 life policy, If you die in year 1, guess how much the insurance company has to pay out?
Fine.
The whole thing. So there's real value there. Yes, the likelihood of you dying, yes, the probability. But however, what if it does happen? That's a lot of money they're on the hook for paying out. So term has its place, whole has its place. It's just looking at the whole overall structure of what can I afford, what am I trying to do, and what's the plan going forward. After today's session, it's recorded, so I'm going to share it on our personal pages. So share with people so they can have perspective on this, and then at least they can just have the conversation. Reach out anytime. You guys are on the social media. Follow our insurance page at Take Two Insurance, but message any one of us. We have Maria, who's hiding her face right now, but she's one of our life agents at the office as well too. There's 4 or 5 of us at the office that's licensed, and if you have somebody you're already talking to that you have with you, wonderful. Have the conversation either way. It's about having the conversation so that way something were to happen, at least you can leave your family with good memories and not debt. So thank you folks for joining.